All right, hello, and welcome to Yet Another Value podcast. I'm your host, Andrew Walker. And with me today, I'm happy to have Shariar, the founder of ReturnOnCapital.com. How's it going?
Good. And you?
Doing good. Well, hey, let me start this podcast the same way I do every podcast, and that's by pitching you, my guest. I really got to know you from your subscription service, ReturnOnCapital.com. I mentioned in my December monthly links and things, it's one of my favorite services. It reminds me so much of Scuttleblurb, which is one of my favorite services. So this is absolutely high praise. Every time you posted on something, I felt like I was becoming an expert on a sector or a specific company. I loved it. Over the weekend, you sent out an email that said you're moving on to bigger and better things. So I'm happy for you, but I'm sad for me because I'm sad that the service is going to be going on. But really happy to get you on to talk about something before you kind of shut it down for real. So anything you want to say about Return on Capital or anything else?
Yeah, the blog was great. Yeah, unfortunately, I wasn't able to keep it going. But yeah, I enjoyed it. I would consider, I don't know if I would say expert, but I'd consider myself a curious amateur on these industries. And I'm glad people liked it. The whole goal wasn't necessarily to pitch stocks or anything. The goal was really just, I was already doing this research on the side, and I figured, why not make it public so other people can benefit as well? So, I got some decent traction over the year. I obviously did not expect the popularity that it got. So I was really happy with the feedback there. And yeah, I met a lot of great people. So I enjoyed keeping it, but unfortunately it had to go.
Yeah. One of the things about running subscription service I found, I don't know if you found, but I always found it's like a backdoor way to a lot of, if you write the right stuff and price it right, like a lot of smart people kind of subscribe to it. And in a way, they become invested in you. And it's like they actually are hitting you up like, hey, here's holes in your thesis, or here's a really interesting company I think would be for you. And it's like, I have all these people almost who are paying me and they're giving me ideas or like increasing my knowledge and stuff. I've just loved that experience. I don't know if you feel the same way or different or anything.
Yeah, we're going to talk about RH. I got a lot of feedback on RH just because it's such a controversial stock. But yeah, it was great. Especially, I'd post something and you have like someone who's been covering the same industry for years just reach out to you and just have a conversation. So it was great. Definitely benefits on both sides.
Perfect. And that's a great transition into the company we want to talk about today is Restoration Hardware, RH. You wrote it up in June. This has been a popular battleground stock over the years. Right now we're taping this at the end of January. Short squeezes with GameStop and everything are all the rage. But a couple of years ago, Restoration Hardware had a really interesting short squeeze where they bought up a ton of the stock and the stock just ripped. But it's continued to do well since then. I think the battleground's been decided in the Bulls' favor. Stock's up 15x over the past few years. Berkshire Hathaway bought it in late 2019. So why don't you tell me and the listeners, Restoration Hardware, background, bull case, what got you interested in everything?
Yeah, the first thing is that Friedman would skin you alive if he heard you call it Restoration Hardware.
Okay. All right, that's my fault. That's my fault.
But yeah, I think just that's a great segue. The company started as Restoration Hardware. It sold antique furnitures and things like that, and it was kind of sitting on the remnants of society until Friedman came along and back in 2015 had the idea of what he calls elevating the brand and making it something that could stand on the shoulders of LVMH, Hermes, and Apple even mentions. And that's kind of the whole strategy. He rebranded the company as RH, and went on a strategy that's kind of looked down upon by Wall Street, right? In a world where everyone's kind of focused on e-commerce taking a bigger and bigger share of revenues, of total retail revenues, he decided why not just do a massive capex expenditure and massive store rollout across the nation. And it just didn't jive well with people in the beginning, right? These stores took a long time to ramp up. If you look back, I think 2015, 2016, this company was operating at 1% to 2% margins. When you look at companies like Herman Miller, HNI, Kimball, they're all operating, I guess you can call it, as mid to high single digits. And so the strategy wasn't necessarily, it was lavish, but it wasn't working. And so a lot of people bet against the company. And then he levered himself up 3-4 times and bought back 40% of the stock. And it's done well since. here's how you'd characterize the bull thesis is that it's not really about e-commerce or brick and mortar. It's about how you execute on each of these two strategies. And I would say that RH has done very well on that front. I mean, fast forward 3-4 years, and the company has gone from 2 to 3% margins to about, most recently, I think they hit 21%. I mean, albeit in a pandemic, but they were still able to hit in 2019 mid-teen margins. And again, that's double what you see in firms like Erman Miller, who were here since the 1800s. And they kind of just shattered the industry ceiling. And so from there, the rest is history. Once Friedman proved that, and not just that, if you read this company's earnings calls, he's very, very good at playing the market and driving up his multiple. And he has a huge personal stake in the enterprise. And so all those factors come together, brought the company to where it is today. I think, it's a controversial stock, it's a controversial company, and it's a controversial CEO. But he's so far been able to prove the naysayers wrong, and we'll see what happens. But I think you have the situation where you have, a company with no real peers combined with an operator that seems to know what he's doing, and this shrewd person who knows how to take advantage of opportunities as they present themselves. You marry those two and you have a company that can potentially compound for a while. And yeah, that's a story, but then the math also works, and we can go into that as well.
Let's go into math in a second, but I do want to dive deeper into it because I might not be the target audience for this. My wife I'll walk in, I'll say, oh, that's a nice new painting. She'll say, oh, it's been there. I hung it 4 months ago. I just don't know this stuff. But when RH, right, this is high-end furniture. They're selling at 20% margins. And when I think furniture, I basically just think in my head, oh, that's a furniture. They're selling furniture, right? There's no moat there. That should be pretty low margin, pretty capital intensive. And obviously all these numbers that you've talked about or alluded to so far are blowing that away, right? They're building out a luxury brand, 20% margins. These stores, I think they take a little bit of time to ramp up, but once they ramp up, great returns on capital. So what is the moat? How are they building? One more thing before I let you answer. With brand, one of the toughest things is to build a brand in something that people don't do a lot, right? And when I think, hey, going shopping for furniture, I think you move into a house and maybe you do it, I don't know, how often do people do it? Once every 5 years, once every 10 years, where they do a home remodel? How do you build a brand when somebody's doing something that infrequently? So I guess my two questions to you are, what is the moat? And I think part of the moat is the brand. And how are they really building a brand in something that seems really undifferentiated?
Yeah, and I think you hit the nail on the head, right? I mean, it's furniture. It's not something you don't buy furniture for the brand, first of all. And I think he realized that really early on, which is why these galleries aren't furniture stores, right? They're not a rooms to go that you've seen in the past. These are galleries with restaurants, with wine tasting and things like that, that are really meant to be social circles. I mean, I'm not the target audience either. The target audience are the really, really affluent. But even my friends and acquaintances, they'll tell me that, hey, we just went to RH just to hang out. We didn't buy anything. We just went to hang out. And so what he really created here was a customer acquisition tool. You have people coming into your galleries. You have people wining and dining there. And then you can sell them furniture on the side. And so if you go to Chicago and you look at Sunday brunch, and you see that the RH, which has a brunch spot there, is basically full. And on top of that, you can start adding other services, not just furniture. You have interior designers. You have a market for freelance architecture to commute with the people. So it's you created a brand around the gallery and around the experience, not necessarily around the furniture. And the margin isn't necessarily on pricing. A lot of it also comes from just the distribution model, the fact that the stores aren't necessarily, they don't necessarily store inventory. and they really service the entire country with simply 2 distribution centers. And so that's done a lot to help the margin. But yeah, there's a little bit of pricing there. And what was your other question?
I think it was just on building the brand, and I actually think you hit that well. But let me dive a little bit deeper in there. So, like, I think RH. So I live in New York City, and I know one of the things they're doing is they I think it just built out. They built out a store like in the meatpacking district. I think it's a store, hotel, restaurant, all these things that you talk about. And you mentioned the Chicago. Did you say Chicago, the brunch spot that's like full every? And I get all that, and that's building a brand, right? But at the same time, like, there are plenty of popular restaurants in New York City that sell out for brunch every Sunday, and it seems weird to attach popular brunch spot or popular destination to go get wine to this is a $10 billion high-end furniture company. Like, how did he marry the two, and how does drawing people in for brunch every Sunday or wine tastings or whatever, how does that sell the furniture and build this brand that's way bigger? I think in his letter I tweeted out, he said, 20 years ago or so, we were a $20 million company and we were putting a laundry detergent on the front of our cover. Like, how did he go from that to this $10 billion furniture selling company?
Yeah, and I think he was inspired by what he saw at Apple. And if you go back to 2018 and you look at some of his talks then, and some earnings calls from that period, and also their investor presentation that they had at the time, he really says that Apple created what he says a brand like no other. And I think he was really referring to the ecosystem there, right? Mm-hmm. The ability of Apple to sell you an iPhone and an iPad, an iMac, and whatnot. He's trying to do the same thing here, right? Where there necessarily isn't any integrated service, right? Let's say you're an affluent couple, you're going to move into a new house in Beverly Hills. You need to enlist an interior designer. That interior designer is going to contract with a company like H&I, like Herman Miller, to actually design the place. And you contract with someone else to actually build the place. So it's a very fragmented process, and no one really thought of marrying the 3 aspects together. And RH isn't there yet. RH is trying to get there, but I think that's his big vision. And when you look at some of the recent investments they're making in development and things like RH guest houses, that's what he's trying to do. He's trying to create an environment in which you come in and you get all the services given to you on a silver platter. And given that, I think he was able to create that customer lock-in that other companies simply haven't seen. And on top of all of that, he builds a direct-to-consumer relationship that other companies that sell through department stores or through contract sellers or general distributors simply haven't been able to build, which is why you don't see people going specifically for the Herman Miller sofa or specifically for the Kimball desk lamp. Mm-hmm. Whereas in RH, you're actually going to the RH store. And I think that is pretty valuable. We have yet to see whether he will eventually marry the 3, architecture, design, and furniture. But I think we're in the early innings of that, and it's certainly doing a lot to help the company's multiple today.
So RH Guest Houses, correct me if I'm wrong, they're literally rolling out RH, hey, it's a hotel. It's our brand hotel, and it's got all of their furniture, their design, and everything. So it's almost a double thing, right? Like, they put it in, the big one that they just announced is it's a $105 million investment they're making into a resort in Aspen that's going to have a bunch of RH stuff. And actually, they'll also, in this, it's an equity investment, so they'll invest in other stuff. But it's a high-end resort with RH Guest Houses, hotels. They'll hopefully make money from the hotel and everything. And then people will go in and they'll experience the RH lifestyle at the hotel and maybe buy their furniture or have their house designed. Am I thinking about that correctly?
Yeah. He calls it the RH ecosystem. And it's funny because, when I was originally looking at the company back in February, he never used that term. But I figured that's kind of where he wanted to go to. Just look at the influence he got from a company like Apple. And so, yeah, he calls it the RH ecosystem. Basically a one-stop shop where you really go for the social experience, and they cross-sell you the real business, which is the furniture. Yeah.
Go ahead.
No, that was it.
And so is the end game for this, and I'm just imagining, this is just talking to me, like one of the things I was really interested in recently is Peloton, and partly because I got the bike, partly because I'm interested in the company and the stock and everything. But Peloton, I think when you look at it right now, it's the bike, but over time, increasingly, they're going to have the Peloton lifestyle things, right? Like I'm sure at some point they're going to be selling a ton of just gear, shirts, shoes, all that type of stuff. Is RH over time, as the ecosystems expands, is going to be, hey, anytime you travel to an affluent city, Tokyo, New York City, Aspen, they're going to be trying to lure people into the RH guest house, and then are they going to be selling clothes at some point? Just a whole RH lifestyle. Is that the end game?
Yeah, I think it's limited to Friedman's imagination. And that's certainly on his. I don't know, about clothes or anything like that. But yeah, he's definitely trying to get into the development business, right? Actually develop these houses for you. You have a concept that you want to move somewhere. He wants to take you from there to actual move in, everything in between. So that's certainly something he wants to do. But here's the thing, right? The people, I guess nowadays the popular word is optionality, right? Those are all options on future developments, right? And what attracted me about this company wasn't necessarily all those options, which for some of these other valuations, you actually need to believe in order for the investments to work out. But just doing the math on the current strategy, the investment kind of works out. And you can choose to be a believer in his vision or not. And so that's what attracted me when I first got involved in RH, when I first looked at it back in, a year and a half ago. Where if they just continue their gallery strategy, so right now they have about 24 galleries. And I think they're trying to get to, they say 60 to 70 in the US. If you just assume 60, just employ a Peter Lynch style way of thinking about it. And you can kind of back out what the so-called TAM in the US would be. On the other hand, you can also just look at major metropolitan areas. And in my post, I actually talk about both methods. And you basically get a figure of this company essentially being able to produce anywhere from 600 to 800 million in operating earnings by 2025, 2026, depending on how quickly you think the rollout will happen. And from there, the valuation makes sense. Now, if you believe in the other optionality, then you believe his 10-year vision where he's going to become the next Hermes, but that's another question entirely.
Hey, my computer froze up for a second there. Can you hear me?
Yeah, I can hear you. Can you?
Okay. Hopefully there was nothing. No, that all made sense. I guess one thing. So we were starting to get into numbers. So I guess I'll go start from the end and we can work our way back. So I think you and I were messaging before this. In October, they filed a new pay package for the CEO, and I think this is about the third one they've done. But the high end of the pay package calls for per share by May 2025. That's how he gets paid, the highest end full amount of payment. That would be 14% annualized from today's price. So it sounds to you like you think that pay package, pretty likely that he's going to hit the high end of this by May 2025. Am I kind of thinking about that right?
Yeah. I can go through the math if you want, like back of the envelope.
Yeah, let's go through the back of the envelope math, please.
Yeah. So, and it's just by my head. You can check my post to see the exact numbers, but each gallery is doing about 18 million in sales, and you have to kind of divide them. Like the New York gallery is doing about 35 million, and some of the other galleries, their low galleries are doing about 10 million, which already tells you something about the business because, I always compare it to Herman Miller because they're also trying to roll out their direct-to-consumer strategy. And their AUV is nowhere close to 10 million. But anyways, you can back out about 15, 18 million per new gallery. And so right now they have about 24. So if you get to about 60 galleries in the United States, that gets you to about 4 billion, 4.5 billion, which lines up nicely to their estimates. Now they also think they can get Europe, but let's put that aside for now. The biggest question.
Can I pause you for 1 second? You've mentioned 60 galleries a couple times, right? Where is the 60? I can't remember if the company gave 60 or not specifically, but where is 60 coming from? Because 60 is a strange number, right? Like there's, I've heard people say we want to hit the major sports league cities. They call it the NFL or NBA cities or something. And I think there's 30 to 40 cities like that. 60 is a little bit above that. Normally you would hear something like below 50 or in the 100 to 120 range. Is there any number behind 60, or do you think it could be plus or minus, maybe plus 20 or 25 or something?
Yeah, so 60 is what they say. They say 60 to 70. Now, alternatively, like you allude to, you can also take the major markets. So there's 30 to 40, really large metropolitan cities in the U.S. And they also take into account that some cities have multiple galleries, right?
Yep.
So in California, it's interesting. He's so colorful on his conversations. You can actually back out some geographic figures. But in California, 2 quarters ago, he was saying that it was doing about 450 million in sales. He thinks he can get that to 700. Last quarter, he said it was 500 million in sales. And I believe they opened another gallery there over the past year. And so there's some opportunity to do, call it on average, 1.5 per large metropolitan city, just to take into account some of the really large cities. And so that gives me a little bit of confidence in kind of the 60 number. Can it be higher? Yeah, but I think this is a pretty reasonable bet, and it's kind of on the lower end of what they say. And I think we can also talk about kind of Gary's strategy of under promising and undershooting people's expectations, just so he can outperform when he reports numbers.
If I'm going to go to an RH and get a home designed by them, how much am I going to pay to get a home designed?
Well, right now they do it for free. That's the thing. These are options, right? And so
I guess how much am I going to pay? They designed it, and then I get all the RH furniture and stuff. How much is it going to kind of be on average, do you think?
So what was that? Sorry.
So if I go get the design, but then I'm filling it with a house with the RH furniture and stuff, like how much is the average trip transaction or whatever going to be?
I don't think they break that out. Yeah.
Okay. Because I'm just wondering, like, I think it would be pretty high. And, I am kind of wondering, let's say Houston and Dallas, right? If they've got one in Houston and then they're going to go open one in Dallas, obviously they're going to increase their sales. But I almost wonder with something that, is this expensive and happens this infrequently, if there's almost a little cannibalization when you open a store 4 hours away. Like if I'm going to buy a super high-end car, I'm willing to drive 2 to 3 hours to go, buy if I was. All right, we had some technical difficulties. Hopefully I'll be able to edit this together, but I was basically asking about cannibalization when they open store. So I'll let you take it away from there.
Yeah, I mean, there's definitely going to be, some cannibalization. I think, the biggest aspect of cannibalization is the fact that they're closing all their legacy galleries, right? And so each of these legacy galleries, you're doing about half of the AUV. And they're replacing them with some of these newer galleries. That being said, there's basically going to be on net a revenue uplift, right? If you just consider the replacement of the legacy galleries into the new galleries, and you can see it if you look at market by market. So look at Chicago, look at Atlanta, look at Dallas, I believe, and then look at New York. And specifically focus on the markets. And what I did was, first of all, you can map these all out on Google Maps and kind of see time when things closed and when things open. But essentially what you'll see is that there's about a 2 to 3 times revenue uplift when you basically so-called replace a market with a new gallery. And so based on that, another way you can kind of back this out is take revenues when pre-2015 and give it that uplift. So assume a full transition. So anyways, any way you cut it, you're getting about 15 to 18 million per gallery. And then you're getting about 60 galleries. And so whatever that gives you, I believe I backed it out to be about 4 billion in sales. And you can, argue when that's going to happen, but they're saying they're opening 3 to 4, or now they're saying 5 to 7, but previously it was 3 to 4 a year. And so that gives you that. And, the big question, I think, and if you look at what sell side is saying, the biggest question isn't necessarily what the revenue is going to look like. The biggest question are what margins are going to look like. Mm-hmm. They basically proven the revenue model over the past three to 4 years. and this was what I had trouble with too as well. I mean, if you read my original RH post, I was forecasting about 15% margins.
Yep.
And I thought that was overly aggressive. I mean, I looked at every other comp and they have 8-9% margins. I didn't really appreciate the distribution model, how efficient that was. It's basically a Warby Parker for furniture, and Warby Parker is massively profitable. You have the direct-to-consumer relationship, so you don't have that the lower margin distributor sales or wholesale sales. Anyways, so I said, 15% margin. That turned out to be grossly incorrect because when they reported Q4 numbers, they were already operating at an 18-19% margin. And like I said, most recently they hit, this past quarter, they hit 26%. This year so far, they've hit about 21%. And so the margin estimate was grossly understated. But even then, back when it was trading about 200, I basically got a mid-teens IRR on that price. And just on a free cash flow basis, it was trading at low teens.
Mm-hmm.
And so this is a company if you just think about a company with a low teens multiple, you don't need to assume much will go right. So everyone was focusing on things like interior design, on things like architecture that didn't really need to be figured out for the thesis to work out. You really just need to assume that they continued a strategy that has been working for the past 2 or 3 years.
Yep.
And assume they do it for another 2 or 3 years. And the investment would have worked out fabulously. At 500, or what is it? Yeah, about 460, I think right now. At 460, you need to assume a little bit more. You need to assume they actually get full penetration in the United States. But again, the margin estimate has changed as well. And so when I revisited the stock again, my mid-year review and then my final year review, I found myself upping those estimates on margins because the company was just proving me wrong every single time. Later at 18% and later at 20% margins. And so right now I have about 20% margins.
You mentioned, we talked about we got interrupted, but we talked about 60 stores domestically. You mentioned US. When I think of luxury brands, I think most of them get the majority of their revenue internationally, actually, right? Like Louis Vuitton bought Tiffany's, and I think Tiffany's got like 75% of their revenue internationally, if I'm remembering correctly. I'm kind of doing that off the top of my head, but most people get most of their revenue internationally. And like Tiffany's, even the revenue they do in New York at their flagship store, a lot of it was international tourists coming in and buying goods at Tiffany. So, obviously furniture distribution, and you're right, it mentions a little bit there in the UK, and they think they might even be able to distribute from the US to cover UK and stuff. How do you think about the international opportunity there? Is there a lot of upside? Have you baked anything into your numbers? Do you think this doesn't play out internationally?
Yeah, I mean, you've read my post for the year. You know that I always lean towards being extremely conservative, almost to a fault. And so you could probably answer that second question yourself. But realistically speaking, right? Not with numbers I underwrote to make an investment, but realistically speaking, Gary says that the European market is basically almost double the size of the California market. He always uses that as a comparison. He says Europe market is about 1 billion. He says the other advantage of the New York market is that the AUV is going to be far higher, just the population density and the fact that you don't need to open as many galleries per square foot. Per square mile versus a place like California. Just make the economics much better. And then, like you allude to, he also says that you can just ship everything from the East Coast distribution facility to Europe. So the economics look good. And then he says 1 billion there. The company puts out a report. I think they say 20 billion is the international opportunity, which lines up well to when you look at LVMH and some of these other luxury brands. But here's the thing, right? Gary has instilled in everyone's head that we should be compared to LVMH and Hermes. That's not true. At the end of the day, it's a furniture company. Like the way their whole investor relations strategy is kind of change the comps, right? We don't want to be comped with Hermes. I mean, we don't want to be comped with Herman Miller, H&I. We want to be comped with Hermes and LVMH. I don't think that's true yet. So I do think that a good amount is them tooting their own horn. Um, and like you said, the stock grant that Gary has is pretty lucrative if you can get the stock to 750. And that's one thing I guess you can say what I don't like about the investment, where a lot of it is promotional, which is why it's so controversial as a CEO.
I think you're right. Yep.
But the funny thing is he's controversial, but he also delivers on his promises. Well, he said 20% margins, he got 20% margins. And one thing he made very clear, I thought, which is why RH might also work or would have worked as a short-term trade. He literally said on earnings calls that we're underselling you our expectations.
Yeah.
We're telling you 20%, we're gonna hit 25%. Yet the sell side never updated their models, and then they were just proven wrong. The stock rips every earning.
Yeah, and look, yeah, you can. I did not follow the company closely enough to know like the short thesis super well, but you can see the short thesis where they said, "This is a furniture retailer that's trading at 25 times earnings," and the CEO's out here screaming, "Hey, don't comp us to other furniture retailers, comp us to Louis Vuitton." And the short seller's just like, "What the heck is this guy? What is he talking about? What's he doing?" Let's dive a little bit more into the bear case now. So, I think the bear case today, you can come at it from a couple different angles, but I think probably the best would be, hey, 2020 was maybe the best environment for these guys in history, right? Like everyone was upgrading their homes. People, major cities, people were fleeing, especially the affluent, were fleeing and doing anything to get out. I mean, it probably pulled a ton of demand forward. Maybe it created unsustainable demand pulling it forward, right? Like the guy who lived at the penthouse at the top of Park Avenue, he went to some Aspen house and he wouldn't have done that otherwise. And that's a demand that's never coming back, right? So I think they would say, hey, yeah, it's over 20% margins now, but all this demand was pulled forward unsustainably. By the way, if you ever got like a real recession that really hit, especially the affluent, this would be a disaster for them. And you laid out in great detail how this can grow and all this stuff, but I think they would also say, hey, if you look at trailing numbers, this is still a physical retailer. It's trading at 20 times EBITDA. And EBITDA, the DNA is real there. They're investing a lot of money into these stores. There's a lot of cash costs. It's expensive. So I think all of that would meld into the overall bear thesis. So kind of how would you respond to this?
Yeah, not just that. One of the important things is that all of their low margin businesses are not operating. Their restaurants aren't operating. All of their experiential sort of human capital intensive businesses within these galleries are not operating. And so that actually pulls up your margin. And so the real margin is a lot lower. And we saw a glimpse of that, right? When the pandemic first hit and they had to close down every single one of their galleries and furlough whatever number it was of employees, right? You saw the operating leverage in play. Not just that, but the stock also fell to $70. So there's a lot of valid points there. But I think the correct way to view it is kind of in the middle ground, right? Where yes, they are a furniture retailer. They should not be comped with LVMH and Hermes, but they should also not be comped with Herman Miller because they've been very, very consistent. In even 2019, which is a normal year, they generated 15% margins, which is double the furniture industry. And so that people with a bear argument have to respond to that. Not just that, but when it comes to these CapEx buildouts, you have developers literally fronting all of the CapEx requirements to build out these galleries just because they know that they're going to get a huge demand uplift from when the gallery opens. And so that increase. I think they mentioned that they have about a ROIC of about 50% on some of these capital light deals. And so you have to respond to that as well. So that's kind of where I would respond to the bear arguments, that you have to look at the middle ground, and you have to also respond to the fact that this company has been successful with 24 different galleries that have been. I can't think of a single new gallery that has not generated a 20+% IRR. And so the model is working. I think in 2017 you had much better arguments, and I'm sure if I looked at this company in 2017, I would have passed. It would have been a hard pass. I may have not even read the full annual report. But I
Yeah.
think looking at this company in 2019, 2020, it's doing much better, and the multiple reflects that. Someone recently responded to me on a Twitter post. They basically said, "I don't know if it's going to work or not, but I would not bet against Friedman." And I think that's a general strategy amongst these short sellers, where they're thinking, he might be right. It might work. No one wants to bet against it. I think there's still. I'm also kind of skeptical of the long-term model working out. I wouldn't pay. If you really believe Europe's going to work out, if you really believe this interior designer is going to work out, you should be willing to pay about over $1,000 for this stuff. I don't necessarily believe that.
So I want to back up to the point before that. Actually, you said I wouldn't bet against Gary Friedman, the CEO. I think there's two things I kind of think about here. He's controversial, but at this point, I think he's pretty much proven it, right? But there's two things here. One, how do you think about the key man risk, right? Like a lot of this is in the aesthetic, the brand. Tim Cook did a nice job taking over for Steve Jobs, but I think for a lot of these really brand heavy kind of designer vision heavy things, when the key man leaves, the company crumbles within 2 or 3 years, right? So I guess that's point one, and then I'll follow up with another point after you respond to that.
Yeah, and I think that's an important part of the RH thesis, where it's really, I don't know if you've noticed in this conversation, we keep saying he did this. We don't say the company did this, right?
Yeah.
A lot of it is Friedman is the one who's doing this. So that's an important thing. Very similar to how Warren Buffett built Berkshire Hathaway. Very similar to how Steve Jobs built Apple. So it's so a lot of it depends on betting on Gary Friedman, and it's interesting. I think the way he's been described is basically like Steve Jobs. And I actually mean that in a bad way. Because Steve Jobs wasn't the most fun person to work with. He was very irascible, and we know him, in his final years as this nice dude who was unveiling an iPhone every year. But if you in his 30s, he wasn't so nice. He got in a fight with Eisner back when he was chairman of Pixar. So it's a big bet on Freeman. And he's so far delivered. But I think he's also someone who believes in his strategy a lot, to the point where it could go wrong. And so they've had mishaps in the past. And I think their biggest mishap was probably RH Modern, right? If you look at around 2017, it was basically a catalog that they essentially, it was not thought out. It was too ambitious for a company that small, and it just didn't get the traction that Friedman expected. Now the interesting thing is that he recognized the error and immediately fixed it, which speaks good about his personality, but I do think he's very promotional. He's very flashy. He pays himself well. So that's something you kind of have to live with. That he's going to take some of your upside with you. And can he leave? If he leaves, the bull thesis is gone. That's a simple way to put it. Because I haven't spoke to any former employees or anything, but I would imagine based on just things I've read, I spent a lot of time reading interviews of folks, him and other people that worked at RH, and without him they have no direction. So it's definitely like an Apple Steve Jobs type play, where if you don't believe in Friedman, you don't believe in the company, you should not be investing.
And that's quite the risk, because he's approaching 65, right? He's what, 63, 64, something like that. He's approaching 65. Obviously 65 is pretty young in today's society, but he's not going to run this forever. So like, what do you think the end game is for RH? Like if he's 65, I believe he said before he has basically 100% of his net worth in the company. It's going to keep getting higher if he can hit 800. Like, is this Whole Foods selling to Amazon? Is that the end game? One thing that pops in my head, Tiffany selling to Louis Vuitton, or does he find the next Friedman who's got the same design and vision and who's 35 right now, and he passes it and they run this thing, they expand internationally, they grow this for the next 50 years? How do you think about that?
He doesn't sell the company. I don't think he'd ever sell the company. And even if he did, I don't know if there would be a willing buyer. You can say Hermes or LVMH, but again, I would imagine that they're thinking that this is a very different business than themselves.
Yeah.
That's not what Gary wants to think. That's probably what they think, and they wouldn't buy it. Um, so there's that. And in terms of the end game, I mean, your guess is just as good as mine. We'll see what happens. We'll see what he does. But rest assured that if he leaves the company or something happens where I mean, we had a scare, right, back when it was made public that he was having a relationship with one of the RH employees. He had to resign from chairman, right? So it was so that was a small scare, and the stock moved in lockstep. And so it proved to be not that severe because he's still in that relationship and he's still CEO. But I do think most bulls would have to reevaluate the whole thesis if he were to leave. I don't think there's a strong second in command in the business. He's also, if you've noticed, he has a very, very strong grasp of the financials. If you read earnings calls, like he just throws out numbers at you as if he was the CFO as well.
Yeah.
So I don't think he has a strong number two, and we'd have to seriously reevaluate the case if he were to leave. Then again, right, all of this, my personal investment, different people might disagree, but my personal investment in the company basically says that you don't need a lot of it to work out in the next 5 years. The company should produce a good IRR. And I would say that this wouldn't be dead money either, because he's shown I mean, mostly because, like you said, all of his net worth is in this one company. He will produce value in any way he can. You saw it in 2017 when he bought back 40% of the stock. And in the recent earnings call, he said that in the depths of the pandemic, they were seriously considering issuing $1 billion in debt and buying back half of the company, which is insane for a brick and mortar retailer with all its galleries closed, with no prospect of revenues over at least the next few quarters.
A, that would have been epic, but B, at the depths of the pandemic, I don't think they would have been able to raise $1 billion of debt. I think any lender would have looked at it and be like, no way, man, no way. The economy's not. Just two more things before we go, because I'm cognizant we're running out of time. One thing, this is such a small piece of the story, but it really tickled me, right? RH has rolled out I think it's $100 per year membership. You buy it. I think if I'm looking at it, you get 20% off all their stuff, which could be a lot of money. I'm sure as they expand the RH kind of in-person experiences, Aspen we talked about in New York, I'm sure you'll be able to go with your membership and get discounted drinks and stuff. But I just think that's interesting, right? Like when I think membership, I think Costco. I think something you go to once a week or once every other week and you're habitually using. Like, I don't think furniture and design that's probably a once a year or once every 3 years purchase or something. I don't think that for a membership. I'm really curious, and I don't think they talk about it too much anymore, but like, how do you think about that membership? Is that the sign of like where this company is going? Is that a sign of the brand strength?
So the reason they did the membership was because he never wanted the company to be judged on price. Again, he wants it to be luxury. And so he doesn't want people to focus on price. And what these other furniture companies will do is they'll have seasonal offers, right?
Yep.
They'll send out a source book every X months with discounts. By the way, can you hear me?
I can hear you. Yep.
Okay, it just said my internet connection was unstable. All right, so essentially, these other companies would send out source books every few months and offer discounts. He didn't want to offer discounts. He wanted the company to essentially be a luxury brand, and that's the real reason for the membership, right? I wouldn't say they're doing it for the revenue model. They're doing it for so they don't have to issue discounts on a lot of their furniture. It helps financially because they have, I guess, more recurring revenues. And like you, I don't know how it would work, but it somehow did work. People signed up for the membership. And I would imagine that the reason that occurred was simply because your audience is very, very price insensitive, and they're very fine signing up for, you said it was $100 membership, which is pennies in the bucket for some of these customers. It's great for RH. It increases the exclusivity of the brand. That's one. Number two, it reduces the variability of revenues. And number three, it kind of changes the model, right? From discounts, when is it? In the third quarter, to a more stable revenue base where you don't really depend on the discount season to drive the majority of your profits for the year.
Do you know how many members they have right now?
I have not checked recently.
I haven't checked either. I was just curious how big this membership is. It's just interesting, right? Like I would have never thought furniture company you get a membership program, but that's what's great about this brand and what's interesting, because you could see how a membership could be used as the backbone for so many different of the options that we've been talking about here. Look, we've covered a lot here. Anything else you want to talk about, get off your mind on RH or anything we haven't discussed yet?
Yeah, I mean, we kind of talked about it, but I think we didn't talk about it enough, where clearly the economics work out, right? But I think what makes it such a controversial bet is just the personality of the CEO. And so anyone really considering investing in RH needs to, understand that this is an eccentric dude. And I would imagine that one would need to do a lot of work on just understanding where this person's head is at, because it seems like every other question that someone asks someone at earnings call, he looks to his compliance officer and asks, "Can I talk about this?" So, and not just that, this is a person who's just going to let his pet projects run. If he has an idea, he's going to do it. No one can really tell him no within the firm, and he can make or break the company based on that. So on the other hand, I mean, I think it's interesting because if you had the same character, but the company did not do well, let's say, these galleries did not work out, the stock was trading at 50, we would say he was a failure. He was a bad personality, bad CEO. And now, because the company's been successful, we're praising him as a visionary CEO who can deliver on his promises and know what he's talking about. He did an amazing bet buying 40% of the company. That one investment has probably produced better returns than any of this company's other capital investments.
Though it's produced better returns, but all of that is driven by him successfully executing on the operational side, right? So in a way, it was a bet on himself, his vision, and he obviously had some internal numbers and stuff, but it was a bet on himself that paid off in spades.
Yeah, exactly. But that same investment, and he hadn't executed, we decry it as the worst investment.
Everybody makes fun of Eddie Lampert nowadays, right? He was buying back Sears at $100 per share, and he said, "Hey, look, every ratings agencies reward other retailers who go and open new stores at bad returns on investment, and we buy back shares." And if you read his early letters, he was very early into, like, he was painting the vision for what Amazon would become. And operationally, F. And because it was an operational F, all of his betting on himself and his vision, F.
Yeah.
It doesn't matter.
Yeah, exactly. So this is sort of company is not for everyone. In my opinion, the math works in 5 years. Whether the math will work in a 10 or 15-year period is up to question. So that's kind of the last word on RH. I think it's going to continue being a controversial stock. It's going to have huge vacillations depending on what he says on an earnings call. And people should be ready for that. I mean, you should know what you're up against going in. And it's not easy when the stock goes to 80 or 70 and he's on the verge of announcing a buyback when all the stores are closed. So
perfect. Well, hey, look, I would recommend people go sign up for Return on Capital. Again, it was one of my favorite subscription services, but you're on to bigger and better things. So we'll look forward to hopefully having you back on the pod where you can provide us on an update on something else. But thank you so much for coming on the pod. Thanks for the Return on Capital, and we wish you luck in the things to come.
All right, great. Thanks, Andrew. Really appreciate it.
Have a good one.
All right, bye.